Two men walked out of the same high school on the same June afternoon. Same neighborhood, same grades, more or less, same $20 in their pockets from a graduation card their grandmother had slipped them. 25 years later, one of them owns his house outright and takes his kids to Portugal every summer. The other is still renting the same one-bedroom apartment 3 blocks from where they grew up, and he just picked up a second job to cover a car repair. Nobody handed one of them a fortune. Nobody sabotaged the other. The difference wasn't luck. It wasn't even income, not really. For a long stretch of those 25 years, the guy renting the apartment actually earned more per year than the guy in the paid-off house. The difference was a handful of ideas, small ones, the kind that get mentioned once in a high school hallway and then never brought up again, because nobody thought to make them stick. Let's start with the one that mattered most, because it's also the one people misunderstand the worst. Money grows on its own. Not fast, not dramatically, but it grows quietly in the background, whether you're paying attention or not. Put $100 somewhere, it earns interest, and next year that interest earns interest too. Small at first, almost invisible, but stretch that pattern across 20 years, 30 years, and the curve stops looking like a straight line and starts bending upward sharply, almost like it woke up. Here's what that actually looked like for our two guys. One of them started putting $50 a month into a retirement account at 22. Not much, barely noticeable on a paycheck. The other guy meant to start too. He just kept telling himself he'd do it once things settled down, once he had a little more breathing room. Things never quite settled down. He finally started at 35, putting in twice as much every month to catch up. By 65, the guy who started at 22 had more money. Significantly more, even though he'd put in less of his own cash overall. The 13 years he lost weren't just 13 years. They were the 13 years when the snowball was smallest and slowest, the years doing the most long-term work per dollar. Time, it turns out, is worth more than the money itself. Now, before anyone goes and dumps their whole paycheck into an investment account tomorrow morning, there's a piece that comes before all of that. A cushion. Life doesn't ask permission before it throws something at you. A transmission dies, a hospital bill shows up, a job disappears without warning on a random Tuesday. The families who weather these moments without falling apart usually aren't the ones who earn the most. They're the ones who kept 3 to 6 months of expenses sitting somewhere boring and easy to reach, not invested, not growing fast, just there, waiting. Our renter didn't have that cushion. When his car needed a new transmission, he put it on a credit card at 22% interest. That single repair, stretched out over 18 months of minimum payments, ended up costing him almost double the original bill. That's the second idea worth understanding, and it's the one that quietly wrecks more people than almost anything else. Not all debt behaves the same way. A mortgage on a house that holds its value, or a loan for an education that raises your earning power, that's debt working in your favor slowly over years. A credit card balance carried month after month on things that lost their value the moment you bought them. That's debt working against you, and it compounds too, just in the wrong direction. Same mathematical force. Opposite outcome. It depends entirely on which side of it you're standing on. The guy in the paid-off house understood something else too, something smaller but sneakier, the cost of money losing value while it just sits there. $1 today buys less than it did 5 years ago. Less bread, less gas, less rent. Cash stuffed under a mattress isn't neutral. It's shrinking, slowly, every single year, even while it looks exactly the same in the drawer. That's why saving and growing your money aren't actually the same habit, even though people talk about them like they are. There's one more idea, and it's the quietest one of all, because it never shows up on a receipt. Every choice about money is really a choice between two futures. Spend $40 on dinner out tonight, and you've also chosen not to have that $40 growing for the next 30 years. That's not a reason to never eat dinner out. Nobody enjoys a life spent white-knuckling every purchase. It's just a reason to notice the trade you're actually making, instead of pretending only one side of it exists. None of this required a finance degree. None of it required a lucky stock pick or a rich uncle. It required noticing these 5 things early enough for time to do the heavy lifting, and then simply not stopping. 25 years is a long time. Long enough for small, boring decisions, repeated quietly enough times, to become the entire shape of a life. The two guys who left that high school on the same afternoon didn't take wildly different paths. They took the same path, just at different speeds, starting at different times, with different amounts of friction along the way. One of them is sitting on a porch in a paid-off house right now, planning next summer's trip. The other one is still catching up, but he's caught on now. And it turns out 22 isn't the only age that works. It's just the easiest one.